We had another excellent session on Wall Street. Stop me if you've heard this before, but we hit yet another all-time high on the S&P 500. That index was up over 1% here today. We also saw a lot of other sectors being driven higher by fallen interest rates, including utilities and REITs and even a little bit of technology exposure there. And we also saw some impact on commodities. In fact, gold was up over 1% today, continuing its recent turnaround. And that's actually where our trade application example will come from later on in tonight's video. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 15th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then come down into the description area and sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZ. And we really appreciate those of you that help support this project by clicking like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at the web address listed in front of you. All right, let's go ahead and jump into today's activity. And as you can see, I've got chart 6D pulled up here in front of us. And this is a chart that I generally pull up if we've got more than a 1% move, either up or down in the market. And today was one of those good 1% moves. It was up 1%, 1.11% to be exact. And you can see how that is kind of shaking out here in this middle indicator. This green bar is up and over that blue horizontal line. That blue horizontal line represents the 1% price move. So you can kind of get a sense of how we've been trading more recently. And if you kind of just zoom your eyes into this area right here, you will see much more often has been the case in recent weeks that we've closed higher than lower. And in addition to that, we've closed more than 1% higher much more often than we've closed 1% lower. And of course, those are bullish dynamics and have helped the S&P 500 continue to grind to all-time highs. Today, we finished just off of the highs of the day. The intraday all-time high now advances to 4173. We closed at 4170 here today. So yet another all-time intraday and closing high there for the S&P 500. Also worth mentioning is the VIX has fallen all the way down here to below 16. We haven't really been paying a lot of attention to that, but typically when you have these nice, calm, grinding higher types of stock markets, usually it comes with a lack of volatility, and that is what we're seeing right here. And so that makes doing certain types of trades maybe a little bit more difficult than they would otherwise. In fact, we had that conversation Monday afternoon in my Options for Long-Term Investors class, and how this particular environment was not ideal for that particular strategy, at least in comparison to where things had been last year in 2020. So we're still presenting trade ideas in that class, as I do each and every week, but I'm always upfront with the attendees, letting them know when conditions are better or worse. And right now, this is not the ideal condition for that particular strategy, at least the way that we implement it on the big blue chip dividend raising types of companies in that class. But anyway, perhaps it's an opportunity for those of you that want to go long calls or puts. You're getting maybe a slightly better bang for your buck right now because you're not paying through the nose in the form of the volatility portion of the pricing right here, with the VIX down here close to 15 at this moment in time. Let's go ahead and take a look here at our normal 4-grid view, which is chart 4B. And as I mentioned to all of you on Tuesday, but just in case some of you didn't catch that video, those of you that are premium members of Market Scholars, I did do a major update to 5 different charts last weekend. So you'll notice this is one that was affected. The date up here now says April 10th, 2021. And so if you need to get updated there with your own Thinkorswim charts, remember you can find that on the tools area of our website. Hover your mouse over that tools tab and then click on premium resources, and you'll find all the shared links and the tutorials that will go with these Thinkorswim charts. Anyway, on this particular chart, you can see that we've got a 4-grid here, and a reminder that the background colors of the charts will tell us whether we've got a bullish or bearish posture according to the market forecast intermediate line. And so that intermediate line is the green line you see down below each of these 4 charts. And that is what is kind of our default setting, so to speak, when it comes to talking about postures. In my Wednesday morning class where we're swing trading, we actually use the blue line. That's a more sensitive line. But from a more general perspective, we're looking at what does the posture tell us about months rather than weeks like we would as swing traders. So in that case, we tend to use the green line here. So anyway, there is something new I can share with you on that front, and that is with the Russell 2000. Remember, on Tuesday, we had looked at the Russell 2000. It was still in that bearish posture. That background color of the chart was that light pink. And so that green line was basically just a hair above the 50th percentile and looked like it was going to cross down and through it. But the last 2 days have actually been reasonably strong days for the Russell 2000. Now, in comparison to some of the other indices, maybe not quite as strong as those, but at least it stopped that 3-day spillover right there. And now we're trading back above that rising moving average once again on the Russell 2000. And that move was enough to kind of turn that green line on the market forecast and tilt it back higher. Again, that's kind of hard for you to see here because it kind of looks flat in all likelihood to you. And that's the whole point of us having the color-coded chart system, so that way we don't have to squint to see, okay, is that sideways, up, or down? It is up a little bit right now. You can also read that within the label, remember, intermediate line currently at 57.11 and rising, and so we would consider that to be strongly bullish. Now, having said that, I think we can all look at these 4 charts and recognize that the Russell 2000 is the one that's kind of been left out of this party. As we're looking at the other charts, we see the S&P 500 hitting an all-time high here today. We see the Dow Jones Industrial Average hitting an all-time high here today. It was up 0.9%. And then we see the NASDAQ Composite not quite being able to make the claim of an all-time high, but knocking on the door of it. I mean, we really have less than 2% to go until we hit a new all-time high on the NASDAQ Composite as well. We just need to get up and through 14,175, and heck, that could happen tomorrow under the right types of circumstances. So I would anticipate that sooner rather than later we'll probably get a new high on the NASDAQ, and that means with the Russell 2000 sitting way down here on its 30-day moving average, it's got a long ways to go before it breaks out to that high that it saw on March 15th. But generally speaking, if market conditions are strong, which they appear to be right now, and these other stalwart indices are leading the way, they might very well drag the Russell 2000 up kicking and screaming. Even if it doesn't want to go higher, it might very well be forced higher anyway. Remember, this is a very accommodative market right now, where we do have the Fed kind of in a dovish mood, willing to print money, willing to pump stimulus into the system. That's generally supportive of stock prices, all else being equal. So obviously we are in earnings season now, and so far a lot of the big financials that have reported have come out with pretty stellar results, quite frankly. Whether that continues through to the other sectors in the coming weeks is yet to be seen, but right now we do see that the financials, the big money center banks, etc., seem to be handling this economy, this coronavirus strange world that we're all living in pretty well. I myself got my second shot yesterday from Pfizer, so I'm feeling a little achy and a little lethargic here today, about 24 hours after getting it, but happy to have it, and knowing that I'll be able to kind of get back into society a little bit more so in a couple of weeks without as many worries as previously. I think that helps. It helps me want to get out and spend some of my money, and it probably helps others in the same situation. And so generally speaking, hopefully this will add to a strong economy that we see here in the United States right now, and that's helping support all of these stock prices that we're seeing as well. So, long story short, we do now have a clean sweep with all 4 of these indices. They all have strongly bullish postures. All 4 of them are also trading above their rising 30-day moving averages. The Russell 2000 is the clear laggard on a relative basis right here. And I would probably say the S&P 500 is our leader at this point in time. In fact, one way you can kind of gauge that as well is just look at the number itself within the label. And right here on the S&P 500, you'll see its intermediate line is at 98.08. And you can see over here the Dow Jones is just a hair below it at 97.5. 0.46. So out of these 4 charts, I think I prefer the S&P 500 one in terms of trend trading conditions. All right, let's go ahead and take a look here at our next chart setup, which will be chart 4D, and this will be our 3 green arrows chart. And as you can see here, we've got more positive news on this front, no surprise. All 4 of our charts here actually have a 3 green arrows signal. And the 3 green arrows signal is just a colorful way to describe 3 different technical indicators that are all lining up bullishly at the same time. So as an example up here, the most recent arrow on the S&P 500's 30-day moving average is a green arrow because price rose and closed above that moving average and has stayed above it all this time. You can also see a couple days after that, we got a green arrow on the MACD histogram, which helps us judge momentum of a security, and momentum has been strong and it's continued that green arrow status ever since then. And we also have a phantom green arrow down below here on the stochastics from approximately those same range of days is right there. And so all 3 of those arrows, remember, they don't need to be lined up identically on every single, all on the same day, but they just need to have the most recent signal be green in each case, and that is the case. In fact, on the S&P 500, we've had a 3 green arrow signal going all the way back here to March 29th. And to keep 3 different technical indicators bullish that entire time is actually pretty impressive. You don't always have that opportunity. In fact, you can just look at this chart here and see that the other times we've had 3 green arrows, they've started to fizzle before where we're at right now on this move. So like over here, and over here, all of those shaded green areas are smaller than the current shaded green area that we're dealing with right now. So maybe one way to think about that as well is maybe we're a little bit extended here, in terms of the amount of time. Then again, we don't really want to bet against this market at a time when it's hitting all-time highs right here. That's a sign of strength. But just know what you're getting yourself into. There's a pretty good chance that you're not going to keep the 3 green arrows for, let's say, another 3 weeks from this point in time. Eventually, another red arrow will sink in. Whether it leads to a trend reversal or not is the real question. And many times when we get some of those red arrows to pop in, it's just a momentary pause before a renewed uptrend again. And that could very well happen going forward. So takeaway here, we've got 3 green arrows across the board on all 4 of the major indices. Let's go ahead and take a look at our 1040 crossover method now. And this is chart 4C for those of you following along at home. And as we're looking at this chart, we remain in fairly strong shape. In the case of all 4 of our charts, we have bullish crossovers of the 10-week moving average versus the 40-week moving average. Some of you might refer to that as a golden cross. And in all 4 of our charts cases, it happened several months ago. In fact, we're about ready to lap the crossover on the NASDAQ on a 1-year basis here within the next month or so. We will now have the claim that we've been bullish for the entire year on the NASDAQ composite. And shortly thereafter on the other indices, we turn bullish there on this set of technical indicators as well. So anyway, great looking charts out there. Improvements on the PPO, I might add as well for a couple of these charts. So notice the green line here on the S&P 500 is at its peak. We actually talked about this in my class earlier today, so thank you, Brian, for that question. But anyway, the green line is at its highest level in the last 3 years. Now, another way to see that very quickly, if you don't want to squint and look at where that green line is right there, remember, if you're reading this label right here and it says 100%, it's basically telling you this is the maximum amount that the orange line has been away from the blue line. And that is generally perceived bullishly as we now have the more sensitive orange line tilting higher at a more rapid rate than the less sensitive blue line here. And that's usually a sign of strength in the near term. And you can see the same claim could be made over here with this green line on the Dow Jones Industrial Average. In fact, that one also is at 100% PPO rank. This is the widest distance between these 2 weekly moving averages here that we've seen in 3 years. So these are very robust market conditions that we're dealing with here. Additionally, you'll notice here that the NASDAQ composite is starting to show an improvement as well. A few weeks ago, we started to see a little bit more wear and tear. We even saw a couple of those red arrows showing up there that were telling us that while the moving averages themselves hadn't crossed over, we did start to see some slippage, and we saw the prices of the securities, in this case the Nasdaq Composite, closed below its 10-week moving average. So the good news is it was able to kind of gather itself and start rallying higher here again, and we're not quite to all-time highs, but we've rallied enough in the last 3 or 4 weeks where we've stopped that decline in the orange line. Notice down below, this green line was tilted lower, telling us that this orange line was going back down towards the blue line. But here in the last week or so, we have a slight tilt higher there in that green PPO line, telling us that this orange line has now resumed its uptrend versus that less sensitive blue line in that case. So that means that the Russell 2000 then is the only one that at this moment in time is seeing a pinching of those two lines as opposed to an expansion of those two lines like we see with the other 3 indices. Let's go ahead and pop on over here to the internet briefly. I always like to get an opportunity to say thank you to those of you that help support this product on YouTube. Remember, it is available for free, and we don't monetize it in any other way. So we don't, sell your information, or we don't, sign up advertisers that we have to pause our analysis for and have you listen to something that you might not have an interest in. So we do this purely promotional and educational. In other words, we're hoping that we give you education by doing these videos, and we're hoping that you will help promote us. And as long as we have that kind of give and take there, we'll continue to do the videos. As long as I'm getting 100 likes, I'm generally satisfied. We start getting less than 100 likes on Twitter, then maybe I'll start doing the videos without as much of a full effect. In other words, doing like a 15-minute version of the video and no trade application example, as opposed to this normal process of 30 minutes and a trade application. So if you like the 30-minute version and you want to continue to get those trade application example ideas, then make sure you're doing your part to click like for us there on Twitter. So we had exactly 100 people do it this time around. That doesn't happen too often, but thank you to all of you, including Susan and Chris and Claire and Keith and Jim and Kirk and Paul and Victor, etc., etc. A lot of great folks there. Also, while we're over here on the internet, a reminder that the factor selector I just produced here on Wednesday morning, or I at least put it on our website on Wednesday morning. Wanted to mention that we have seen more deterioration there in the low size factor. And if you've been listening to these market outlook videos recently, that should not come as a big surprise. The Russell 2000 is clearly lagging the other 3 major U.S. broad equity indices. And so when we compare that now on a factor basis, you can see we've seen slippage, and low size is actually at its lowest ranking here over the last 3 months. If you kind of track this brown ball backwards, you can see low size was once a leading factor here kind of in February, and now we're all the way down here to the number 4 slot. So keep your eye on that. That's some pretty intense deterioration that's taken place there in the low size category. We see some nice benefit from the dividend yield category. We've had a lot of chatter on some of our most successful dividend investments on Twitter this week, whether it's Lowe's or Microsoft or Northwestern. There's been a ton of dividend stocks that have been absolutely rocking it from our classes here recently. So not a surprise to see dividend yield making its way up to the number 2 slot there. But our bookends remain value continues to lead this market, and low volatility continues to lag this market at this moment in time. I did teach my question and answer class earlier today. Now at this exact moment in time, it's about an hour after the stock market has closed here. I actually don't have the file back yet. So the way that it works is we conduct our classes on Cisco WebEx, and then WebEx has to send the recording file back to us, which we then post to our website's trading room calendar. Usually that's a pretty quick turnaround process, but for some reason they haven't sent me the file back yet on my class today. But I'll keep my eyes on that, and hopefully they'll get it back to me here within the next hour or so. And once I have it available to me, I'll get that uploaded to our website quickly. But this will give you an idea of some of the topics that we talked about in class here today. We had a general discussion on how to submit questions to David and myself. We had a question on the iron condor that I did on intercontinental exchanges and how we manage a trade like that. We had a general conversation about leaps, long calls, in terms of Starbucks and Discover are a couple of the successful ones we've had. In fact, that Discover long call leaps trade Yesterday was its 1-year anniversary. So for those of you that want to go back in time and listen to my analysis from exactly 1 year ago and what was going through my mind and why I thought Discover was a very interesting choice to have a leveraged bet to the upside, I did retweet that yesterday. So if you go to my Twitter timeline, you should be able to find that. But anyway, those contracts have done fantastically well. They're up 450% in 1 year's worth of time. So that one worked out great. Anyway, we also talked about American Tower, talked about one of the unique potential competitive disadvantages that cell phone tower REIT may have in the future if there's a certain disruptive technology that takes hold the way that some people think. We also talked about the PPO line, like I mentioned before, on chart 4C. Had a question about what those little green and red dots represent there in terms of the extremes. So if you need a refresher on what those mean, then feel free to check out that portion of the recording. Also had a conversation about the sector selector tool and the stock selector tool, and looking for some areas that had pulled back recently but are primed to kind of be bouncing going forward, and how we can go back and look at historical data that kind of feeds that particular tool throughout time. And then we also had a conversation about how to navigate towards the stock selector tool, and then also how to download all of the data from that stock selector tool to either an Excel spreadsheet or to the Google Sheets option that some of you will use. So lots of great stuff as always in our class today. And I know David taught his portfolio management with ETFs class earlier today as well. So look for the recordings on both of those if you are a premium member of Market Scholars. And then tomorrow, David will be teaching his very popular technical analysis class. So make sure you're taking full advantage of all those excellent resources. All right, let's get back on track here with some other charts. And let's do some 12 grid analysis. I wanted to talk about gold and the interest rate environment and things like that. So let's come over here to chart 5A. This is our asset class 12 grid. And as we're looking at this, you can see that we've got a lot of green charts on the board, which we generally favor, but there are 3 pink charts on the board. Let's start with the one in the lower right-hand corner, because this was one of the bigger stories of the day in the financial markets. We actually saw a pretty healthy drop in the interest rate environment today. We're actually trading at 1-month lows on interest rates here. So remember, the opposite of that is also true. We see bond prices going up over here when we're looking at the long-term U.S. Treasuries. At the same time, we see the inverse of that, the interest rates or the yields falling lower. And so that can help support interest rate sensitive areas like utilities and REITs. And there's also a benefit to high growth technology stocks. And so those 3 sectors actually did pretty well today. We'll talk about that here in just a little bit. But this was a monumental day here for Treasury yields. You can see that this is the first time in 3 months that we've closed below the moving average. And we didn't just barely close below it. I mean, it was wrecked here today. That was an aggressive move right there. A lot of times you just kind of dip your toe behind there and you kind of have this back and forth between buyers and sellers for a few days. But that didn't happen here. This thing just sliced straight through that moving average. So that was a pretty ugly move. Want to keep our eye on that and see what it means going forward. But that could start pressuring the financials. We'll see if it does. Like I mentioned earlier in the presentation here, the financials that have reported earnings recently have just knocked the cover off the ball. I mean, they just crushed estimates in many cases. So their business is firing on all cylinders right now, but we'll have to remind ourselves that much of that was when interest rates were rising. If we have now entered a new quarter here at the start of April, and this quarter is dominated by a storyline of interest rates falling, then we might actually see the flip of that. In other words, financials might start falling, going forward. We'll see. It's probably a little too early to tell, but that is a big story. We want to keep our eye on it because it does have an important impact on many other areas of the market. Also, we do have foreign bonds with a light pink background color, kind of joining the 10-year U.S. Treasury yields. In this case, they are trading above that rising moving average, however. So it's green moving average, but pink background color. So while we still have a weekly bearish posture, there is some important constructive activity taking place on the chart, and it's possible that foreign bonds take the lead of what's happening here in the United States, where we're starting to see a little bit more separation here above that moving average. You can also see high yield bonds have benefited. Remember, high yield bonds are a bit of a different animal there. They kind of are hitched to oil prices a bit more. So with oil prices now back above that rising moving average, that's really helped those junk bonds hold up a bit better. So anyway, I wouldn't be surprised to see foreign bonds chart turn light green here rather quickly. In fact, it would probably go dark green because the intermediate line is at 55 and falling right now. So if it were to start going higher tomorrow, that would be a strongly bullish posture because it would already be above 50. And then the last pink chart on the board is the one in the lower left-hand corner, and this is the U.S. dollar. Had mentioned this on Tuesday. We had a big aggressive down move on Tuesday, and we've continued to slide since then. In fact, this has been a very consistent move to the downside ever since topping out, by no coincidence, with that overbought cluster signal. So there's a prime example of why sometimes those overbought cluster signals can be a good takeaway to kind of lighten up your bullish trades in that particular area, or perhaps even reverse your trade, go from bullish to bearish. Doesn't always work that way, but that's a nice example of one where it worked perfectly, because right on that candle right there where it touched its highest level was exactly when we got the overbought cluster, and we've basically just been going straight down since then. So that does have an impact on things like commodities and foreign assets. And you can see here that oil, as I mentioned before, is now trading back above its rising moving average. In fact, earlier this week, a lot of those oil stocks were starting to really stumble. And then here yesterday, we had a huge snapback rally in many of those oil companies. And it did continue here today, probably because oil itself was up yet again. Notice here with oil, we also had an overbought cluster signal. In that case, that led to this decline. However, this one's not quite as clean, because you can see we had overbought cluster signals back here as well that did not work out. So that one was not quite as strong of an example as what we see over here with the US dollar. But nonetheless, with a falling US dollar, it is supportive of higher commodities prices. We are seeing that with the rise in oil. And now let's talk about gold. You can see gold was up 1.62% today. Not only that, but we have a dark green background color as opposed to the light green there with oil, telling us that we have a strongly bullish posture using that intermediate line. It's up at 74 and rising. In fact, you don't see charts often like this that are nearly about ready to enter the upper reversal zone on the intermediate line, yet its price action is well below its 3-month highs. So there could be some upside potential here as we have a little bit of a reversal of trend in gold. And remember, I've been talking about this for several weeks now, in that I've been waiting for us to get back above that moving average and then for us to spend some time above that breakout zone. And today was an important candle because we were back above that breakout zone. Remember, yesterday we were back a little bit below it. So you're kind of just waffling back and forth here. It was good that we were hanging out above the moving average, but what you like to see is progress over on the right-hand part of the chart. And with us closing as high as we did on gold today, we can now say that this is the highest price that it's traded at since going back to February. So we are seeing legitimate progress here, and we might actually have a bullish reversal in the cards here for gold in the near term. On the top side of the charts, you can see we've got green across the board. Out of the four at the top, the one that looks maybe the least appetizing is EEM. That's your emerging markets foreign stocks. And like I was mentioning on Twitter the other day, I had discussed this with you guys on Tuesday's video. But what I didn't realize was how poorly China was doing. Shanghai in particular is trading at 3-year relative lows to the United States. So if you were to look at the Shanghai index all by itself, it doesn't look like it's in some sort of a major breakdown. But when you do it on a ratio basis and compare it to the US markets, you actually do see the the Shanghai index breaking down. So there might be more than just Shanghai there in terms of what we see with the emerging markets. We could have several emerging markets that are struggling on a relative basis if you were just to look at this chart right here and then compare it to the S&P 500. However, the foreign developed markets look a lot better. So, Japan, Australia, Europe, those types of markets are going up very nicely right now and kind of keeping up with the U.S. markets at a pretty good clip. And then we don't talk about preferred stocks all that much, but preferred stocks are actually rocking it right now as well. And they're starting to break out to new highs. Remember, there can be some interest rate sensitivity there with that kind of bond alternative asset class there as well. So with the reversal in bond prices, we're now seeing a reversal higher for preferred stocks there as well. Let's go ahead and take a look here at our sectors. So that would be chart 5C. And there's only one red chart or pink chart on the board, and that is energy. That was the same on Tuesday when I did the video, and it continues to be the case. So despite yesterday's nice rally out of some of those oil companies, we're still not able to get back up above that moving average. Notice the moving average itself is once again falling. Price is below that falling moving average, which is now red. So we have this intermediate line reading at 18, which is in the lower reversal zone. If that were to start rising and get above 20, this chart would then flip back to green. I think there's a decent chance of that happening simply because oil prices and commodities right now are being supported by a falling dollar. Then again, we had so much fat to burn off in this chart that it might take a little bit of time to have that giddy up and go because, this was a spectacular performer from basically February 1st here until March 10th. We had a way above average type of performance there with oil stocks. And so this might be kind of them going into the penalty box to kind of burn off that fat a little bit despite oil prices themselves still holding up reasonably well. Otherwise, we've got green charts across the board. And one thing I'll point out is I brought this up, I think it was in Tuesday's video. I said, be on the lookout for a potential inverted head and shoulders reversal pattern playing out on healthcare. And it looks like we're getting it right here in real time. You'll notice that healthcare was up 1.71% today. This was a beautiful looking candle over here, easily getting up and over that previous neckline from back here in late January. So great sign there for healthcare. It's still got a bit of work to do on a relative basis to get up to some of the more strong sectors, but a reversal needs to start somewhere, and that's a great example of one of those reversals right here in real time. You can also see that we had a very strong day out of utilities, which were also up over 1% today. Real estate was up nearly 2% today, and technology was up 1.7% today. So, those areas do get a bit of a positive boost when interest rates fall, and that is what we saw here today. Remember that materials, which was also up over 1% today, gets a boost when the dollar falls, and that is what we saw today as well. Remember, gold and the gold miners would be part of that materials sector right there. So materials is now at a new all-time high yet again. But there, it's hard to just pick one of these charts out, quite frankly, because they're all doing so well. The financials, I guess, was notable for being negative today. And again, keep that in the back of your mind with that interest rate sensitivity that I mentioned to you just a moment ago. Whereas falling interest rates can help support utilities and REITs, it can have a relative negative performance on financials. And today is case in point on that. On a day when the S&P 500 itself was up over 1%, the financials were actually down just a touch along with the energy stocks. All right, let's get into our trade application example. And for this, I'm going to come over here to the swing trading one grid, and I'm going to pull up ticker symbol GFI. Those of you that have traded gold stocks in the past, you might be familiar with this. This is a stock that's been around for a long time. It's not a very big company, and it's based in South Africa, so it doesn't get a whole lot of publicity or press, but this is a stock that's been around for many decades. And it's kind of a little tiny little sub $10 company. But there's a time and a place for gold stocks. And with gold itself breaking out here more recently, it makes you wonder if some of these gold miners will start to follow suit. So this one caught my eye today. It had a very strong rebound. It was up over 5% here today. Not only that, but it was bouncing nicely up and off of this rising moving average right here. And so that's a bullish sign. You can see the moving average itself change to that green color right there, signifying prices back above that rising moving average. Not only that, but you can see the background color of the chart is blue, signifying that the near-term posture is now bullish once again. And you can also see that with today's aggressive move, you could actually make the claim that this is a slight market beating security. Not by much, I'll grant you that, but at this exact moment in time, it has outperformed the S&P 500 just barely over the last 3 months with today's move, because the S&P 500 dotted line is right here, and today's closing price on GFI is right here, just slightly above that dotted line. So back to being considered an outperforming security here. In addition to that, we have a little bit of a bullish near-term divergence here, and you can see that we've got this low on the blue line right down here on April 8th, and then we had a follow-up low here on April 13th, and that follow-up low was a higher low. Now the two candles, price candles that are associated with those two moments in time are this candle right here that I'm kind of circling, and then also this candle right here that I'm circling. And so price obviously fell down during the time when the indicator down below showed an improvement. And that is usually something that is considered bullish in nature as well. So as always, I've placed this trade already. It was placed during the market session today, and I sent out all the notifications and screenshots and all of that to all of you that are the premium members of Market Scholar, so that way you guys can consider the trade while the stock market is still open, rather than having to wait until the next day to place any trades that you decide you want to. And so all of the details are in the Telegram there, but you can kind of see where my levels are in terms of what I'm shooting for with this trade. It's just a simple bullish swing trade where I bought shares of this stock, and my upside that I'm shooting for is just a hair below that prior high of 1041 was the high, so just a hair below that is where I've got my target price that I'm trying to shoot for in the trade, and then my stop loss is just a couple of pennies below yesterday's low. So this one will probably be a pretty quick trade, for better or for worse. Obviously, if it continues its bounce from here, maybe that will benefit the trade. Otherwise, you do have to be prepared when the stop loss is this tight that if this thing rolls over in a hurry, we could very well get stopped out pretty quick as well. So we'll see how it goes, but considering how strong the gold market itself has been performing here recently, and the declining US dollar, that helps support a trade on a gold mining stock like Goldfields that we have right here. So that's what I had for you here today. Again, if you got value out of listening to this presentation and you want David and I to do these videos every day if at all possible, and you want me to do trade application examples and full-length videos, I have one simple request for you. Simply click like for us there on Twitter. I know you have it in you. We know you can do it. It's just a matter of whether you want to or not. And so there are 4 different ways where you can help support us there on Twitter and find that information. You can either look for our Twitter icon directly below our video on our website while you're watching it there, and click that little heart button. You can go over to Twitter directly, and it'll be pinned to the top of my timeline. You can also find it in the description area for those of you that are watching this directly on YouTube or YouTube app. And then you can also find the Twitter link in our email that we send to all of you on our notification list. So however you choose to do that, I'll leave that up to you, but we really do appreciate your support. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.